Welcome to Investor Speedrun. Today, we're covering Bridge's Q3 market commentary. They nailed two calls last quarter, rate cuts and market parity. Here's AI Brian with the Q3 commentary breakdown.
Big tech dominated the market in the first half of the year. Quarter three brought more winners into the fold. The outperformance has raised Wall Street expectations going into next year. Can we expect another year of strong returns? Or will the market fall short of expectations? Let's get into the details from Bridge's team. The market brought more winners in Q3 as 60% of the S&P 500 outperformed the index. Quite the turn of events compared to the first half of the year, where only a quarter of the S&P members outperformed the index. The broadening rally is spread across sectors and company sizes. What caused the change? Monetary policy is one driver of the shift. The Federal Reserve kicked off the anticipated rate-cutting cycle in September with a 50 basis point decrease. What's more, another half a percentage point reduction is forecasted before year-end. What could this mean for the market? Since 1970, the year following rate cuts in non-recessionary periods has been good news for the stock market. Netting an average return of 15.8% for the S&P, investors are hoping history repeats itself over the next year. For those curious, the year after rate cuts during a recession net a 2.3% decline. Monetary policy isn't the only factor, though. Let's look at the broader economic picture. Economic growth has supported the breadth of performance in the market, and rate cuts are an economic tailwind that should benefit small businesses and home buyers. What is less clear, however, is the U.S. government's handling of its massive debt burden. For the first time ever, interest on debt is larger than the annual defense spending budget. This seems unsustainable with no signs of change in the near term. Speaking of government, the upcoming elections will influence near-term investor sentiment. Longer term, they typically have minimal impact on market performance, meaning long-term investors can ignore the political noise in their decision-making. More importantly, there is a high bar for future earnings growth as the S&P 500 had its strongest 9-month start to a year since 1997. Healthy economic growth and broad market participation are needed to meet Wall Street's high earnings expectations.
To wrap up, let's take a look at potential bull and bear cases for next year. The bull case centers on the belief that economic growth and rate cuts will fuel strong earnings growth. On the other hand, the bear case leans on lower conviction that rate cuts will go smoothly, and some contributors to earnings growth, like cost cutting, are not sustainable. That's a wrap on this breakdown. Thanks for watching, and happy investing.